Welcome back. Today we're talking about a stock that has leapfrogged to the top of my watch list. This is one that was not on my radar at all. I think somebody had recommended it in one of the comments for one of my group videos, and I ignored it because I was like, I don't know why. Maybe they had recommended two and I picked the other one, but in the back of my mind, I was like, Garmin's just, the GPS company, right? They're old news. However, I was at this party and there were these people talking about their fitness watches, and I just figured they were Apple watches, and I don't do fitness or do jewelry. I can't wear jewelry for my job, so I don't do that. And then, run, bike, swim isn't exactly my cup of tea. But anyway, I thought they were Apple watches, like I said, but there are all these Garmin watches. So I was like, wait a second, is that the same company that this person recommended as a value stock? So then I started looking into it, and it's really interesting. Like I said, it's leapfrogged to the top of my watch list. I think that this is a great company. It's selling a little bit more expensive than what we usually look at. I mean, look at the PE's 18, the price of sales is 4. But it is close to the 1-year low at $97 a share was the low. Now we're at 101. And you can see, just look at this 5-year chart. It's like really taken a tumble since August last year, down almost 40%. So we're going to look through the financial statements and see if we can get an idea of their competitive advantage from looking at some of those metrics, and then end the video with the valuation on the stock, okay? First, though, I just want to show you their segment breakdown because this is interesting. Okay, so these figures are from their 2021 annual report. So you can see they have 5 real segments. They got fitness, outdoor, aviation, marine, and auto. So fitness would be like the watches and stuff that we talked about, other outdoor stuff, GPS tracking, all that. Aviation, a lot of navigation, especially in small planes. Marine, things like fish finders. I'm sure there's other things as well. Anything navigation, right? They have the GPS network that they built, a long time ago. So they're using that backbone to kind of spin off all these cool new products, all right? So what's interesting is you can see they're ranked in order of revenue, but interestingly, even though outdoor is number 2 in revenue, it's number 1 in income. And then the auto industry, even though it's 12% of their revenue, it's minus 6% of their income. The auto industry, I don't care what part of it you're in, that's super competitive, and it's so hard to make a profit in the auto industry and whatever. All right, one thing I want to show here too is this is each segment over the last 3 years, and you can see their big 2 are growing. So fitness is growing year over year, outdoors growing year over year, both revenue and profit. Aviation's had a really good year in 2019 and then dropped off in 2020. Duh, right? I mean, that was COVID, and now it's recovering a little bit. Marine's growing. Well, auto's not really much for them, right? All right, well, that's enough about their segments. Let's dive into their quarterly reports. So what I have first is total revenue, and this is for every quarterly report going back to the first quarter of 2012. So the last 10 years of financial data, we're going to look at every quarterly report. Now, this is a seasonal business, so you are going to see some ups and downs quarter over quarter, but that's fine. That's really normal for product companies. What we're looking for here is that the general trend is upwards, and yes, it is. All right, so that's a good sign. That's really all we're looking for total revenue. I don't like using price of sales. I think that's a dumb metric. I don't recommend using that for anything. All right, let's see what else. Gross margin. Okay, we're going to look at a couple percentages. So gross margin is a great way to judge competitive advantage because a company that has a high gross margin is able to charge a premium for its products, because gross margin is how much money are you left with after you've subtracted out, whatever it costed you just to make it, like the pure raw materials to make your goods. How much over that are you able to charge for your products? A good rule of thumb here is 40% is good, but more importantly is that consistent and not shrinking is good. And you can see we're well above 40% and we're pretty consistent. I mean, I know recently it's a little bit down, but still, I mean, this is pretty flat, right? So that's a plus. One red flag that I want to show you about this company is this. This is their research and development as a percentage of their gross profit. So the reason that we look at this to judge competitive strength in a company is that you want to know if a company is putting a ton of money into research and development, especially a product company, especially a highly competitive technology product company like Garmin. That high R&D means that they're having to constantly reinvest to stay ahead of all the competition, right? If they were to stop this, then they would probably lose market share pretty fast to some of the big boys like Amazon and Apple, right? And that's kind of what concerns me a little bit about this, not gonna lie, but it's really going to be one of the only red flags, I think. Just for an example of a company that has a really good durable competitive advantage, think about Coca-Cola, right? They're not having to constantly research and develop new products. They got the same thing that works. That's one end of the spectrum of what really good looks like. but you're going to see this with technology and product companies. You just have to be okay accepting this risk, right? That you require a lot of research and development to stay ahead. And you have to trust that your scientists and your engineers are better than the other company next to you, right? All right, so that's R&D. Next, we're going to do diluted earnings per share. I say always use diluted earnings per share. It just keeps things simple, right? And what we're going to do here is get a value for what they've recently been earning, then get a growth rate for the earnings, and then look at their historical PE. And we're going to use that later in the valuation section. All right, so what I'm going to do here is I'm just going to I'm going to take the average of these last, 1, 2, 3, 4, 5, 6 quarters. So the average of the last 6 quarters was, let's see, $1.40 per quarter. So $1.40 per quarter. I want to get that to a yearly number. So I'm going to multiply by 4 and I get $5.60 for earnings per share. I'm going to put that over here in my outline, $5.60. All right, and now I need a growth rate. All right, so to do a growth rate, there's a couple ways to do it. You can just kind of ballpark it and say, what is this, like 5 years ago? What is this, 2018? So 2018, they were making like $1 a quarter. So $1 a quarter would be $4 for the year, right? So I would do 560 divided by 4, and they went up 1.4 times since 2018. And then I need to make that an annualized growth rate, so I raise that to the 1/4 because 2018 was 4 years ago, right? And I get a growth rate of 1.08 or 7, so 9%. I'm gonna round up. So I'm gonna put 9% as my growth rate. All right. And then next we're gonna look at historical PE. So let me pull that up. First we're gonna look at the trailing PE, and let me change this ratio. All right, so the trailing PE is going to be whatever earnings multiple they're selling on off of based on their last 4 quarters of earnings, okay? So you can see historically, this is going back 10 years again, they've traded between, let's say, 15 and 25, maybe as high over 30 at one point, but that's probably an outlier. We're not going to, account for that. Really between 15 and 25 with maybe an average recently of 20, but back in the 2012 to 2016 timeframe, they were probably averaging 15. So I'm going to put historical PE between 15 and 20, and we'll use that in the valuation. All right, so that's all we got for the income statement. I'm going to move to the cash flow statement because we want to go over some things there as well. First up is free cash flow, and this, kind of like R&D, is going to be another one of our kind of red flags. I say red flags because this is not going up like the earnings are going up. All right, it's really kind of steady. It's not changing much at all. You're hovering between $100 million and $200 million a quarter in free cash flow. So let's make that per share. So let's say between 100 and 200 would be 150, right? So 150 times 4, they're making about $600 million a year in free cash flow. I'm going to divide that by the number of shares, which I have up top there, 193. So divide by 193. And you can see we're only making like $3 a share in free cash flow versus earnings of $5.60. So that's a little bit concerning. So the free cash flow is only 55% of your earnings. So like I said, a little concerned about that. I want to see why. And what we're going to look into is depreciation versus your capital expenditures. So depreciation is how much money your assets on paper are losing in value. And this is what affects the income statement. It's not real cash leaving your business. It's just how much you're writing off for tax purposes. And you can see we're about, let's say, $40 million a quarter in depreciation. Capital expenditures is actually how much cash you're investing in new assets or upgrades, that type of thing, CapEx, okay? So you can see in this case, it's more like $60 million a quarter, sometimes touching 120. So that's why, that's triple your depreciation you're spending on CapEx some quarters, and usually you're spending about 50% more. So I would say that's one kind of red flag, right? You want to make sure if the company's got high CapEx, that they're doing that to build future cash flow, that it's upgrades, that it's going to be increasing capacity, that they're going to be able to make more money from it. If they're having to do more capital expenditures just to maintain their current earnings, that's not good. So you want to feel comfortable and make sure that the money's being spent on what you think is going to positively affect earnings. All right. So now we're going to move to dividends, also in the cash flow statement. This is in the financing part of the cash flow. So the reason it's negative is because it's cash leaving the business, okay? So cash leaving the business going to the stockholders, into your pocket, is going to be negative because it's leaving the bank account of the company, okay? What I've done is I've divided this by the number of shares and turned it positive to kind of give us a better idea in dollars per share for dividends. So what you can see here is they're paying out about 67 cents per quarter. So on a yearly amount, 67 times 4, so $2.68. So they're paying $2.68 right now in dividends. And then for dividend growth rate, what I'm going to do is just go back 10 years. And you can see 10 years ago, they were paying like 45 cents. So 67 cents divided by 45 cents. They went up 1.48 times in 10 years, so I raised that to the 1/10. And you can see we've had a dividend growth rate of about 4% per year, okay? All right, that's going to come into play later in the valuation section as well. All right, now let's go to the balance sheet. First up here is total tangible assets. And the reason I like to look at this is because I'm going to pull up return on tangible assets. Return on tangible assets is very, very intuitive. It's like how much money are you making, and then divide that by the amount of assets that you own, and it's like an efficiency rating for the company, right? How good are your assets at making you money, okay? And we're going to do tangible assets just because I prefer to do tangible assets. All right, and now let's see it. Okay, so I'll put it in percentage. Seasonal, which is the first thing you'll see, but we're not going to pay attention to that. What we're looking at is kind of that general trend, and what you see is it's over 15%, which is solid. That's a good rule of thumb. Return on assets over 10% is great. But then also, look at this, it's also growing. So your denominator of the equation, your total assets are increasing, but you're also increasing your return on those assets, which means that your income is growing faster than your assets are growing, which is awesome. That means that your business is running more efficiently, that you're getting better at using those assets to make money. So this is definitely a plus, this return on assets. I really like that. Next, we're going to look at cash and debt just because this is wild. You need to see this. Okay, so total cash. This is going to be all their cash and short-term investments. What is this? 1.8 billion dollars in cash. Okay, so keep that in mind. 1.8 billion dollars in cash. Let's see how much long-term debt they have. Okay, I go over here to total liabilities and I'll find long-term debt. 0. No long-term debt, which is just, that's beautiful. They do have some leases though, so let me do long-term debt plus lease obligations. So where is that? Long-term debt and capital lease obligations, about $80 million. Okay, so remember I said it was $1.8 billion in cash and then $80 million of debt and leases. Okay, that's wild, okay? Even if I compare that $1.8 billion of cash to their total liabilities, so all of their liabilities, they only have $1.4 billion of total liabilities, so they have more cash than all of their liabilities combined. That is awesome. That's one of my favorite things I've ever seen, right? That's super impressive. All right, what's next? Number of shares, okay. So for number of shares, we're going to look and make sure that they're not diluting, and they are diluting, but if you see it, it's very, very small. So what's interesting here is that they're paying dividends, so they're making the choice to return value to shareholders, but they're not buying back shares. So what that tells me is that management is very shareholder conscious, right? Because they're constantly raising the dividends, paying more dividends, but that they don't think the stock has been undervalued historically, right? That they didn't think it was really undervalued from this 2017 to 2021. Let me pull up the stock again. So that'd be the last 5 years. And you can see that, yeah, I mean, they had good reason to maybe think that way, right? It was probably super inflated. I mean, PEs were probably, close to 30. So I can kind of understand that. You do not want management buying back shares if the stock's inflated. You really don't want that. I know some people and some channels preach stock buybacks are always a good idea, but for the continuing shareholder, like if you're going to be a shareholder for a long time, if the company is buying back shares at an overvalued price, that's not helping you at all. You'd much rather have that money as a dividend than as a share buyback, okay? That being said though, look at this. I mean, the stock's coming back down. Maybe if we're thinking it's undervalued, which you'll see at the end of the video, maybe it's time for them to start buying back again, and we'll see. All right, lastly, I want to look at tangible book value per share. So this is like their equity. So all of their equity minus their intangible assets, minus their goodwill, and then divided by the number of shares. And what makes this super impressive is that they're able to increase the tangible book value per share while also paying out close to half of their earnings as dividends. So think about that. It's easy to grow whenever you have all the money and you're keeping it in the business and you can just grow because you're not sending it out to anybody, but they're freaking dishing it out to all the shareholders, half of it out, and still managing to grow their net worth. Okay, so that is also a good sign. It's a sign of great management. And look at the beautiful things that happen whenever you don't have a lot of debt, right? I mean, it makes running a business so much easier, right? So that's it for the financial statements. Let's move to valuation. Okay, so we're going to do something a little bit different here. We're going to do a discounted dividends model with a future PE. So this is the scenario we're going to play out. We're going to predict what the stock price is going to be in 5 years or some number of years, and then use that discounted value, assuming you sell it at that price, and then add in the amount of dividends that you would have received for holding it in that time period to get what we think is a fair value right now. Okay, so first off, what do we think the stock price is going to be in 5 years, let's say. So current earnings is 560. Let's put that there. Then we'll do number of years, and I'll do 5 years like I talked about. Earnings growth rate, we'll say 9%. So let me put 9% there. And you can see that we're projecting in 5 years to have an earnings per share of $8.62. All right. Now, future PE ratio. What PE do we want to use? I said 15 to 20. Let's say 15 for now. Okay. And maybe we'll do another valuation and see what it looks like at a 20 PE. All right, and then a discount rate, let's say everybody's been using 12.5%, so let's use 12.5%, okay? So what we're saying is that if you held this for 5 years, on the conservative side, you'll probably be able to sell it for $129 a share. But that value discounted back at a 13% return is only worth $72 to you right now, okay? So it's not like you're going to be losing money, but your opportunity cost might not make it the best investment at the moment, okay? However, we have not factored in any of the dividends that you're going to be taking in, right? Because this is assuming that you're going to buy it and sell it in 5 years. Okay, so this is the cash that you're going to bring back. But cash that you're also going to get from it is going to be the dividends from the company. Okay, so let me pull that up as well. Okay, so for the dividends, this is similar to a discounted cash flow, but we're going to do it from a dividend standpoint. So year zero, or like right now, you're getting $2.68 on your dividends. The dividends are growing at, what did we say, 4% a year, and then discount back at 12.5%, let's say, so 12.5. All right, so what this is saying is that right now you make 268, a year from now, 279, 290. Okay, so those are the dividends, okay? But discounted back, they're worth this amount here, okay? So even though in those 5 years you're going to receive $14.50 in dividends, they're only worth this number here, this running total, $11.52. So what I need to do is add $11.52 to our price that we came up with in the other one. So let me go back to that. All right, so here it is, $72 plus $11.50. All right, so we think it should be worth $83, $84 a share right now. Okay, so like I said, that scenario is earnings grow at 9%. 5 years from now, you sell it at a PE of 15. That it's worth $83 a share right now if you do that scenario, okay? However, 15 has been the low end of this PE for a long time, and this is what you'll see for really good companies. You know, you'll see higher PEs whenever they have no debt and they're growing and they're constantly returning value to shareholders, paying a good dividend. And that's why I quoted Phil Fisher up top, right? Because he was like the king of not just investing in cigar butts, but finding really good quality companies that were going to grow and buy them at even sometimes a little bit overpriced because he knew that they would, you know, grow into a better valuation, all right? So let's say that you can sell it for a PE of 20 in 5 years, all right? How does that change the valuation? So now we're at 96 plus 11. And so now the value of the stock right now is $107 a share because I take the 96 and I add the 11 from the dividends that we're going to get. All right, so what are my final thoughts? I think this is a great company. I would love to own it. I'm probably going to start a small position and hope for another dip in the market that maybe I can add. Hopefully below like 80 or below 70 would be freaking awesome, but I'd probably settle for something below 80 or 85. That's just my thoughts. Like I said, I think it's a great company. I think that you're still getting a really good return on your money if you buy now, right? I mean, I'm saying that if you buy and hold for 5 years, you'll be able to sell it for 172 in 5 years in this scenario, the 20 PE scenario. What makes it not necessarily undervalued is opportunity cost elsewhere in the market. That's just my opinion. If you want to see other deep dives on companies, check out my channel for more. Thank you for watching.